and dear ones are safe and healthy. Along with me, I have Mr. Arvind Podar, the CMD, Mr. Bajaj, President Commercial and CFO, and SGA, our Investor Relations Advisor team. Let me begin with the performance updates. The demand continues to be strong in agricultural segment across geographies. In other segments, demand continues to remain stable. Our diversified products portfolio, strong presence across the globe, multiple sourcing bases of raw materials, and strong balance sheet with no long-term debt makes our company resilient to face any challenges and maintain competitive edge in the global market. Our strong brand recall, coupled with wide range and superior quality, is helping us in the marketplace. Let me now update you on the thought process about our manufacturing capacity. Our current achievable capacity is 305,000 metric ton per annum, which includes the 5,000 ton per annum of ultra-large all-steel radial mining tires. Due to the evolving demand scenario in the end markets, there is a significant change in the product mix. This has resulted in a redundancy in some sizes and product technology on a regular basis. Accordingly, we believe our achievable capacity will come down to around 280,000 metric ton per annum. However, this will not affect our growth prospects for the financial year 22 and financial year 23. Further, in order to address the growing demands of our products in the end markets, we are currently evaluating various options on the drawing board with respect to capacity additions, and our plans revolve around as follows. Modernization, technology upgradation, automation, and addition of certain balancing equipments. This would lead not only to capacity addition, but also increased productivity, quality, and efficient levels. Additionally, we are exploring investments by the way of a brownfield Capex at existing locations to increase the capacity further to help us grow in the years to come. All the above is under evaluation stage, and we shall inform you of the detailed contours in the coming months. With this, I now move on to the performance highlights. Our sales volume for the quarter was 61,224 metric ton, a growth of 36% year on year. This is the highest ever quarterly sales for BKT. For half year, financial year 21, the sales volume stood at 99,230 metric ton, a growth of 3% year on year. For half year, financial year 21, 51% of the sales came from Europe, 23% came from India, 14% came from Americas, and the balance came from the rest of the world. In terms of channel contribution, 71% was contributed from replacement segment, while OEM contributed to 25%, with the balance coming from offtake segment. In terms of category, agriculture segment contributed to 64%, while OTR contributed to 33%, and the balance came from other segments. Our standalone revenue for the quarter stood at rupees 1,551 crore, which includes realized loss on foreign exchange pertaining to the tune of 27 crores. For half year 21, financial year 21, the revenue stood at 2,493 crores, which includes the foreign exchange loss pertaining to sales of rupees 14 crore. The standalone EBITDA for the quarter was at 527 crore with a margin of 34%. While for first half of the year, financial year 21, the EBITDA stood at rupees 779 crore with a margin of 31.2%. Other income for the quarter stood at rupees 28 crore, which includes unrealized gains of rupees 10 crores and other income from investment of 18 crores. For first half of financial year 21, other income stood at rupees 40 crore, which includes unrealized loss of rupees 19 crore and other income from investment of rupees 59 crore. Coming to the next net forex items, for the quarter we incurred a net forex loss of rupees 4 crore, which includes realized loss of rupees 14 crore and unrealized gain of rupees 10 crore. For the first half of the financial year 21, we incurred a net forex gain of rupees 11 crores, which includes realized gain of 8 crores and unrealized loss of 19 crores. Profit after tax stood for the quarter was recorded at 339 crores with a margin of 21.9%, while for the first half of the financial year 21, it stood at rupees 461 crore with a margin of 18.5%. Our gross debt stood at 816 crore. Our cash and cash equivalents were rupees 1299 crores, implying a net cash position. The board of directors have declared a second interim dividend of rupees 4 per equity share. This is in addition to rupees 3 per equity share for the quarter one of the financial year 21. On the guidance front, with the volume of 99,230 metric ton achieved in the first half, we expect to cross financial year 20 sales volume in the financial year 21. This will be marginal, subject to no further deterioration due to COVID-19. With this, I conclude my opening remarks and leave the floor open for question and answer. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on a great set of results. So for my first question is on the demand momentum. So, given the trends which have been really strong, and given that seasonally fourth quarter is a much stronger quarter for us, so will it be fair to say that the current trends may continue sustainably, or there is some amount of pent-up which may normalize? So your thoughts on that?
So as we've been saying that we are expecting a marginal growth in the financial year 2021. This is because the COVID-19 wave is returning to Europe, which is our major market, and hence we want to be a little conservative in our approach and guidance. Okay.
And secondly, so on the Capex side, some more color if you can help us understand why has been this reduction? Is it only product mix because we could have then used that capacity for this remaining products, and otherwise add some more color on the brownfield Capex. How much is the quantum we are thinking about? From when will that start? Given that now we will maybe touching close to 90% utilization levels in next year only. So yes, sir. Any if you can quantify this thing, it will be relevant.
So as I said in my remarks, this is regarding the new Capex and the brownfield. It is all in the drawing board stage, and give us some time. We will come back to you with more numbers and more clarity in the coming months once we are gone through the detailed process of evaluating at our end. And regarding the capacity, which is you asked that can we throw some light on going down? The reason for that is because certain technologies become they go out of the thing. New technology comes in, so we have the new technology, but the old technology tires stop being used. So that is why there is there, and also there is some product mix. So what we could make in those with the on those machines, the capacity comes down because newer technology requires more time to make more. So you have certain loss of capacity related to that, and hence this reduction.
Okay, but like for every 30,000 or 50,000 ton, how much will be the Capex? Any color if you can give on that?
We will get back to you once we have more clarity on what we want, how we are going to do it, and then give us a couple of months. We will come back to you.
Okay, sir. Thanks. I'll come back in the queue.
The next question is from the line of Nishit Jalan from Axis Capital. Please go ahead.
Hi, sir. Thank you for taking my question and congratulations on very good set of numbers. So my first question is on volume performance. If I look at the segmental performance, I think Europe has done extremely well in the first half, and obviously it has been largely driven by agri segment. While in Americas, I think we have seen some decline in first half. So just wanted to get a sense, is the agri growth in Europe more industry based, or we have seen a decent market share gain as well? You may not have exact data, but some color on that would be useful. Secondly, a related part is, in 1Q, our inventory levels had come down very, very sharply because we were not able to produce in India. Just wanted to understand how are the inventory levels with dealers in your key markets, both in Europe and in US.
So, firstly, I'll answer your question regarding the European segment. So it has been a mix of both. Segments where we have taken some market share from our competitors, and overall, the market has also seen strong demand, which has led to an increased volume. And as you rightly said, that the inventories level had shot down quite significantly, which is now being slowly built up. So it is a combination of all three things which are coming up in Europe and resulting in these numbers. But overall, it is led by strong demand in Europe at the moment.
Just to follow up, now our inventory levels are at normalized level, or do you think that we would require those are still below, and we would need to fill some channel inventory as well?
We would need to fill some channel inventory as well, because there has been a strong demand. So whatever we are shipping is also, if they are not able to fully use that for inventory filled up, it is going to the end user. So then that yet needs to be built up.
Okay. Thanks for that. So my last and second and final question is on gross margin, or basically the RM cost. We have seen some increase in natural rubber prices in the last few months. So just wanted to understand, given that the demand scenario is so strong, do you think that we would be able to take price increases and kind of negate that impact, and thereby continue to maintain a healthy 32 to 34% kind of an EBITDA margin? So what would be your thought on this front?
Yeah, so as we've always maintained that our EBITDA margin guidance at a sustainable level would be between 28 and 30%. So that is what we continue to indicate on a long-term sustainable basis. As regards the price increase, we are looking at the same, and we are trying to see how much can we pass on and from when. We are in discussions with our channel partners about the same. Regarding the raw material prices, Pajaji, if you would like to throw some light on that.
So, good morning, everyone. The prices are on increasing trend, and the rubber prices, which in the last quarter was 113 rupees per kg, currently it is 130 to 140 rand. And there is too much fluctuation in the prices. Some days it goes $100 up, and another day it may come down $50. So yes, prices are on increasing trend for the most of the raw materials.
Okay, sir. So just one very quick housekeeping question. What was our euro realization in this quarter, and how are we hedged for the remaining part of FY21 and in FY22?
Okay. But
our euro realization for the quarter was 82.4 for second quarter, and for the first half year it was 83.4, and for the next half year is around 85 rupees.
And for FY22, sir, you would have done some hedge for FY22 as well?
No, first half. Second half I am talking about up to March.
Yeah. For the FY22 is also around 85 level, but we are just evaluating. We just started doing something over there, but it is at the same levels of 85.
Okay, sir. Thank you so much, and all the best for the future.
Thank you. The next question is from the line of Ronak Sarda from Systematic Shares. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on your decent set of numbers. So just a couple of clarifications first. This euro INR rate for Q2, which you mentioned is 82.4. This is after the realized losses, or the realized losses are over and above that?
This is after the realized losses.
Okay, so this includes. Okay, fine. And the second was, what was the production during the quarter?
Just 1 second. The production during the quarter was 61,223 tons.
Okay, fine. So again, the question on capacity. While we understand there's some technology shift has led to this, but it's a significant almost a 10% loss in capacity. So would you be able to point out which segment has led to this? Is it maybe because of radialization, or because I think the product mix have moved towards agri segment in the current year. So has agri segment also seen a sharp radialization? What has led to this 10% cut?
So basically, it has been a slow process over the times with a time lag, and this is a product situation. So it's not just technology, but it is a product situation which has moved. The product mix has moved. So as we move, when I say technology advancement, there is bigger sizes have started coming in. Even if you look in the agri side, people are preferring bigger sizes because it does more work. So those are the results. So a machine which could build, if you have to build a smaller tire, you could build two. And now if you have to build a bigger one, it takes 1.5. So that's the reason why this has come. The VF technologies have come in. That is what we are trying to indicate. That we want to be on the higher side of the technology, and the cut that we are indicating is between 6 to 7% and not 10%.
Okay, sure, right. And the second question was on the India volumes. I mean, we have seen a tremendous success in last 3 years here. So how's the situation now? I mean, can we continue to grow in similar fashion in India, or how's the market trending now in India?
Yeah, so India market trend is strong, and we are gaining good pace. I mean, good market share also at a good pace in India, and we expect this to grow. And India will eventually be a good dominant market for us. So we are quite upbeat on this Indian space, and we are focusing here. So you can see the amount of advertisement, brand building, everything that we are doing. And recently with the ongoing 2020 league, we have also participated with that, with sponsoring and partnering with 6 teams, getting a lot of visibility in the Indian market space. So this is a brand that we will focus on, the market where we focus on.
Sure. And the final question was, on the other expenses. I mean, if I look at it, there's been a sharp. It has still lagged the overall top line growth. So is it the normalization is happening? Will happen now, given how the volumes have ramped up, or this is the new? This has been a structural reduction in the cost base, and this should continue the next half as well.
So basically, if you look at it, look at other expenses as a percentage of sales, and this has been stable at 21% levels. So if you put that in, that will continue to be around that level. And of course, there are, as we move on, every day there is a cost efficiency drive. This is a part of routine part at BKT. So those things happen, but more or less we will be stable at 21% levels.
Great, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Good morning, sir. Thanks for taking my question, and congrats for a great set of numbers.
Thank you.
Sir, as the commodities prices bouncing back and infrastructure sector is also picking up, so what is your plan to leverage this growth and expand your market share in OTR segment?
So in the OTR segment, as we've been saying, we are seeing growth over the period of time. So if you look at historically in OTR segment, we were at about 20%. This time is at roughly about 33%. So there has been a growth in our product mix also, which is resulting to this, and we are quite upbeat on this segment. And we are going to go our ultra large radial tires have also been launched for technical purposes now, the 57-inch tires. So we are quite upbeat on this market, and we see this as a strong opportunity for us to grow.
Okay, sir. And sir, so how is the progress in the business in the newer geographies like Africa, South America, Australia, Russia, and CIS countries?
So Some of the markets are challenging because of import restrictions and all, such as South America and Africa. But on the other hand, you have Asia and Australia, where we are gaining a lot of, we have a good market position, and already in Australia we are at a leadership position in the agri sector, and we look to get there in the industrial construction sector also. So we are quite upbeat on those. In the other markets, we are making some headway, but it is coming at slightly slow pace because of the local challenges of import duties and import restrictions.
So what is your current volume contribution from the Australia?
Sorry, what is
your volume contribution from Australia right now?
I don't have the individual breakup because we club it as rest of the world.
Okay. Sir, as of now, revenue contribution from South America is quite low. In the last quarter, we have seen agriculture export is ramping up well in South American markets. So how do you see potential of this region for Balkrishna Industries?
So yes, as I said, that we are making headwinds in this market also. A little bit slow because we want to move cautiously in this market because of the exchange rate risks, etc., and also import duty restrictions, imports and import duty. So we are moving, but we are making headwinds on that. So we are also seeing some uptake on these markets.
Sir, my next question is related with the volume mix export versus domestic in second quarter.
Sorry, your voice cracked there.
Volume mix export versus domestic in second quarter.
So basically, in the last quarter, roughly 14%. No, sorry, 23% came from India, and the rest of them came in the export market.
Thank you, sir. That's all from my side.
Thank you. Before we take the next question, a reminder to the participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. The next question is from the line of Siddharth Bora from Reliance Nippon Life Insurance. Please go ahead.
Yeah, thank you for taking my question. Can you hear me clearly?
Yes, sir.
Yeah. So we understand that reduction in capacity because of obsolescence of product and shift of sales mix. But this capacity can be revamped to the new sales mix within a span of year and a half, or it will require a new greenfield capacity all over for this increasing capacity in the near term?
No, it will be a brownfield expansion that we are talking about. That's what we are evaluating right now. And once we have more details, if we yet feel we need a greenfield, we will come back to the market space.
Okay, sure. So your presentation this time around quite details out a lot of ad spends which you are doing for your branding and overall sales outlook. Is it already included in the numbers, or sizable of it is expected to come in Q3 onwards?
No, so if you look at our average spend, we are spending an aggregate level of to the tune of roughly 100 crore, and that is already included in this. And these are already included, so it's not that it be an extra spend which will come up in the quarters ahead of us. We already included.
Sure. And so for this, our broader guidance of 28 to 30, which has been a medium-term guidance for band, and near-term buoyancy 34% or 32%, can be because of the market conditions of higher Euro INR realization for near-term demand scenario. So it is that the thought process is that over a medium term, these things keep going up and down, and you will achieve a 28 to 30% kind of a margin, or when you go ahead, you will invest in the business to go back to that margin of 28 to 30.
So I think what we are saying is that, as this is 34 is a one-off kind of a thing, but on a long-term sustainable basis, the EBITDA margin guidance will remain 28 to 30%.
Sure. And so this import ban of tires in India has benefited the other tires as well. What happens to the agri-tire space, which is important to us, and the capital goods space as well in India? Is there an opportunity from this recent import ban?
So the import ban was mainly on commercial vehicles, so it does not impact us in that sense.
Oh, sure. Thank you, sir. That's it from me.
Thank you.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir. Good morning. Thanks for taking the question.
So first question is on the between US, Europe, and North America. How are the demand trends now panning out? And between agri, mining, OTR in the different geographies, if you can give some perspective and insights into the demand trends.
So on the agri side, across the globe, we are seeing a good, strong demand, which is visible. And on the OTR mining side, it is stable, and it looks to be stable across the geographies.
Okay. So this it is trends are on the OTR and mining side. It is more or less flattish compared to last year across geographies.
Yes.
That is what.
Yes.
Okay. Understood, sir. Understood.
But agriculture seems to be strong.
Okay. Understood, sir. And in Europe specifically, sir, just addendum to the prior question, we did because of some increasing restrictions. Are we seeing any headwinds there in terms of the demand per se?
The restrictions have just been imposed, and so it's too early to say what the impact will be, and hence we are being little conservative in our guidance because we don't know what way the COVID-19 wave will take, how long it will be there, whether there will be more restrictions, less restrictions. We are also waiting and watching, but too early to say any kind of impact of that because this time round versus the first lockdown wave was they had suspended all economic activities. This time round, economic activities are allowed to continue. So all our OEs are allowed to continue the manufacturing facilities. They've all sent us already emails that there will be no stoppage on requirement from them, so do not cut their tires out. All our distribution partners and their end users have already said that their shops and retail counters will be open. So those activities continue to be open even despite the lockdown. So we are yet going to see the full impact, but looks to be better than what it was there last time round in the lockdown.
Understood, sir. Sir, and on the capacity front, you did indicate some amount of brownfield Capex you may do. So are these any new products or white spaces that we are trying to address here? If you can, is it primarily on the ultra large size mining tires specifically? Any perspective that you can provide on which white spaces and within categories that we are trying to address there? And one other question, sir, on the pricing trend in Europe, are there any early signs of Michelin taking up prices per se? Any early signs that you are seeing there? Thank you. These are the two questions.
So on the first question about the brownfield project, so we are evaluating what is needed to be done and how much to be done. So it's too early to comment on that. There is we are yet on the drawing board, so it will be too immature to comment anything on that at this moment. Please wait for us to come back to you. Regarding the price increase, we are following in the marketplace what everybody is doing. We are talking to our distributors and dealers and partners to see what everybody is doing. And, it is, if the trend continues, everybody will be looking at a product price increase.
Okay. But as of now, we are not seeing any early signs of Michelin picking up anything in our segment. Agree or
Everybody is talking, everybody is in the same boat, so everybody is looking at it, but I think they're just waiting to see how much of this trend continues or what happens. Does it continue to grow? So what is the impact that needs to be passed on? So I think it is a work in progress and you will see it happening.
Okay. Thank you, sir. I'll call back.
Thank you. The next question is from the line of Mayur Malik from BOB Capital. Please go ahead.
Hi. Two questions here. One, when you've seen this volume increase, can you really attribute most of this rise to the impact of Chinese tires in Europe as well, or like we've seen in India, or this is specifically something else also?
So I don't think there is any impact on Chinese tires in Europe because there is no such ban or anything. So I think this is overall the demand is looks good and is strong.
So when you say you've increased your share of business, will this be more in the replacement market in Europe?
Yes. Yes.
All right. And one question on margins. Of course, 34% you mentioned that this one-off and the range would be 20 to 30. But looking at the kind of rise that has happened in natural rubber, it would still mean that, with the kind of other operating benefits that you're looking at, especially lower other expenses, you would be well in excess of 30%. And we're talking of a 400 bits decline, maybe because of gross margins. But do you see an increase in your staff expenses or other expenses other than what you reported in this quarter?
No, I don't think we will see a major increase on that. But, we've always maintained that on a sustainable basis, the EBITDA would be 28 to 30, which is a long-term range. Because, in one quarter, you could have some cost benefit or some, as you see in the raw material, as we now see that the raw material trend is going up. So you will see these on a long-term basis. This is the EBITDA guidance that we are maintaining.
All right. That's it all. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vimal Goel from Union Mutual Fund. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, I'm sorry, but I just missed out on the volume breakup for agri, OTR and others and OEM and replacement part.
Yeah. So I'm giving you half your numbers.
Yeah.
Europe was 51%, India was 23%, 14% was Americas, and rest of the world was, from the balance part of it came from rest of the world.
10%.
Regarding the channel contribution, sorry, you asked channel contribution or segment contribution?
Actually, I asked agri, OTR and others and OEM and replacement.
Okay. So channel contribution was 71% was replacement and OE was 25%. Balance was offtake. In terms of segment, it was agricultural was 64%, OTR was 33%, and the balance came from other segments.
Right. Sir, will the company have to take any impairment charges for this capacity that for this lower achievable capacity now? Do you foresee that?
No.
Okay. So which means that this capacity still could be used for any, could be revamped and could be used for introducing any other product.
Yeah. Basically, the machines are yet able to do the job. It's just we are, because we are looking to move up, grow up in the bigger sizes, bigger ranges. So that's why we're saying. But if we see that, whenever we see demand coming back and things going to a little bit slower and all, lower sizes, we can interchange it. So that's why it is not, there is no impairment charges or anything, because the machines are yet there and they can yet produce that if we desire. It is just that to go looking at the market trend, moving towards larger and bigger things, we are saying that there is a downside. If we feel that it comes back, we can always build that and this capacity will be there.
Right.
It is fully interchangeable, fully flexible, so there is no problem.
Okay. So it is your guidance for lower achievable capacity for now is largely on the current market trends and nothing else.
Correct. Absolutely correct.
Fair enough. I'll take that. So two more questions. Is there any more scope? Which Balkrishna has, historically consistently introduced more and more SKUs, which has been which is responsible for gaining market share across the globe. Is there more scope to introduce SKUs, or are we done with most of the SKUs that are prevalent in the market? That is question number one. And the second question is regarding your margin guidance. So when you say that 28 to 30% is the sustainable range, what kind of gross margins is the management baking in? Thank you.
So regarding the new products, I think that is a part of our DNA, So we have always been saying we're introducing new segments, new sizes, new SKUs to the tune of about 100 every year, which will continue. So I think that continues to grow. And if you can see this current trend also, we are able to hit that wave because of our ability to develop and feed the market with that. So that will continue to be there. Regarding your second question regarding gross margin, that would be go up somewhat.
So what is the gross margin that you are, looking at on a sustainable basis?
So,
And
Bajaj,
after considering the advantage from the carbon black plant.
So this was 61% in this quarter. So 58 to 58% should be sustainable margin.
58.
Yes, around 58.
Oh, got it. Thank you so much, sir, and all the very best. Thank you.
Thank you. The next question is from the line of Basudeb Banerjee from Ambit Capital. Please go ahead.
Yeah, thanks, sir, and congrats for the set of numbers. So already half of Q3 is over almost, and you said that lockdowns have just started. It is too early to get the impact. So can you give a broader commentary that whether Q3 volume of take is more or less similar to this 60,000 plus tonnage which you did in Q2? So in first half of Q3, is it in line with that kind of volume of take?
So I wouldn't be able to comment on Q3 numbers because that is a quarter which is yet there. But as we've said, the demand looks okay. And keeping a conservative view on our guidance, we are saying we will have marginal growth in the year. That is the numbers that we would like to, that is the kind of guidance we would like to continue. Because, as you all know that we don't know how the pandemic would play out and all. There may also be some logistic challenges. So it's better, traditionally BKT has always kept a conservative guidance and we are continuing to do that.
Surely, because sir, if pandemic was not there, the 35% growth and marginal growth is a huge difference. So from that angle, I just trying to understand.
Yeah.
And second thing, sir, if I even prorate 63,000 or 61,000 production, so it is almost annualized close to 250, which is your after the recent today what you said 6-7% further lower production ability. So how much is the time frame from the paperwork being done and to the first production happening for the brownfield? How much time it will take?
So as I said, sorry, as I said in my opening commentary that our growth prospects for 22 and financial year 23 will not be affected. And, that's why we are already starting to think of our brownfield and what we need to do and what is there. In the coming few months, we will make announcements regarding that to maintain our capacities and growth, etc. So that's why we are going to already started working on that. We are not waiting for it to hit the top capacity and then move on. And for next year, we will be able to discuss only early, we will come back to you on this capacity in a few months from now.
So just trying to understand that this your normalized rate of 45 to 50,000 now has moved up to 60,000 plus, and if it persists at that level, then FY22 volume with incremental growth can easily be 260 odd, and then you will have very limited scope to growth because you yourself said even if you leave aside this 6-7% loss in production, your achievable capacity cannot be more than 270, 280. So that leaves hardly any scope to grow. That's why I was trying to understand the timeline for brownfield addition. Or in case you can move ahead to 3 lakh, then it's a different proposition.
So basically, if you see the brownfield additions will also keep on coming and kicking in yearly. It will not take as long as a greenfield project, which takes around 24 months. Brownfield will come in phase manner and continue to grow. So that's why we are quite confident that our growth prospects would not be affected by this.
So lastly, if you announce at the end of CY20, one can expect production can be possible at the end of CY21. Will that be right to assume?
Yeah, so because some part of it, because there are balancing equipments which will help us regain this lost capacity. So, certain balancing equipments are only needed. So it's not like a full setup is needed. So, but please give us some time to come back to you with a better sense and better idea, because it will be we are too early to make official comments because it's a work in progress. So we want to come back once we are ready fully with our drawing, or once we are ready with it on our drawing board. But definitely we know for a fact that certain balancing equipments will help us regain this lost thing, and hence we are not worried about growth prospects for the next 2 or 3 years. By that time, our brownfields and other projects will also come up and be shaped.
Sure. And one small question, sir. I can see nowadays.
Sorry to interrupt. May I please request you to rejoin the question queue for your follow-up, as we have people waiting for their turn?
Thanks.
Thank you. The next question is from the line of Joseph George from IIFL. Please go ahead.
Hi, thank you for the opportunity and good set of numbers. I have a couple of questions. One is, could you give an update on what is happening with the carbon black capacity? How much are you producing? How much is being used internally? How much is being sold to third parties? The reason is that when I look at the ASP that's moved up, and as analysts we do a simple math, take total revenues divided by the reported volumes, and if there is carbon black, external revenue in there, it pushes up the ASP. So just wanted some color there. So that's question number one. Question number two is, I understand that your new Capex plan is still premature to talk about, but keeping that brownfield plant aside, can you give us what is your existing Capex guidance for this year and next year?
Yeah. So regarding the carbon black, our overall third-party sales is less than 2%, is approximately around 2% of our overall sales, and hence it is negligible in that sense. And regarding your question about the projects and the Capex going forward, we are yet working on that, and give us some time. We will get back to you on that with more clarity.
Sure. So my question is not on the new Capex. My question is, keeping the Capex, the brownfield plant aside, not including that, what was your Capex guidance for this year and next year?
Yeah. So this year our guidance was approximately 700 crores, out of which we have spent roughly about 350 odd crores.
Okay. And any similar number for next year, excluding brownfield again?
That would be mainly maintenance Capex next year.
Okay, which is about 200 crores per annum, if I remember correctly.
Yes, approximately.
All right. Thank you. Understood, sir. I'm done.
Thank you. The next question is from the line of Nishan Bas from ICICI Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity and congratulations for healthy results. So my first question is on the US market. Obviously, Europe has rebounded much faster. But what are your strategies that you're putting out in place for implementing market share gains in US? Because that is one market which has probably done below your expectations. So could you highlight what strategies you're looking for this upcycle that you're now going into? One, that would be my first question.
So in Americas, overall, we are doing multiple things. One is we are creating a pull effect with brand spends on Monster Jam, which now is getting us to become a household name. Today people don't, if you looked at it 2 or 3 years back, they would wonder what BKT is, but today they are not, they are aware of the name BKT, and we are seeing results due to that. There is a good pull demand being created. Secondly, our distribution network is being further strengthened in that market. Our dealer network is growing. So those are the kind of things we are doing. We are also developing specialized products per se for the American market. So it's a mix of lot of things that are happening at the back end, which are going to result in getting that market share over there.
So if I had to just summarize your statement, you would say you are more confident of market share victory in US this cycle now?
Yes.
Okay. And sir, my second question is more both on costs and margin. So first on the A&P side, because that has been a big investment that you guys have been planning to do. You planned while the market was down, and you're reaping benefits in terms of market share gain. So in terms of A&P incremental spends, do you think that will trend more in line with the sales revenue growth? So you have like an absolute amount that you think will be your A&P incremental basis spend. Anything you can shed some light on that?
Sorry, your voice was, we could not hear the question. I could not hear your question.
I will just repeat it. What I was saying is, in the last few years when the market was down, you aggressively invested in branding and advertising.
Yeah.
And obviously, you're reaping benefits via market share gains now in Europe primarily. So incrementally, now that the sales momentum is much faster, do you think this cost will remain largely in terms of absolute basis similar, or do you think it will grow in line with sales revenue? How are you planning that A&P?
So our brand spends, as I said, will continue to the same tune, which is approximately about 100 crores per year. We don't see it going up drastically. We see it continuing at those levels.
Okay, and sir, associated question on margins is looking at your organization for a fair amount of time, you have consistently surpassed your own guidances, primarily because you've invested in terms of better product, lower cost structure. Is that base ethos? Because I know you're saying 28 to 30%, but is the base ethos of how the company is progressing going to remain the same, or is it going to be a little different in this upcycle, whichever you're planning? Because both from a capacity building perspective as well as cost structure, is that fundamental changing, or that is likely to remain the same?
No, that will remain the same, but there's not going to be a change in that.
Perfect. Thanks a lot, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Bhaskar Bukrediwala from AST Investment. Please go ahead.
Yeah, sir. Thanks for taking the question, and congrats for a good set of numbers. So a couple of questions on the medium to long-term outlook. Just wanted to understand, between the agri and OTR tires, how do you see the volume growth over a 3 to 4 year period? And would your OTR segment grow faster, given that there is a scope to increase market share from where you are today on the OTR side?
So definitely, we see that the OTR segment will grow faster for us because it's a smaller pie of the overall thing. So that will continue to happen. But overall, both the segments look to be having a good demand, and we see good opportunity for us there.
Would you be able to give any broad number range like you gave for margins on the volume side for next 3 4 years on both the segments separately?
Sorry, the voice was unclear. Would I be able to give you what?
Would you be able to give a volume guidance, like you gave a margin guidance of 28 to 30%, volume guidance for both the segments separately for the next, let's say, 3 to 5 years?
No, at this stage, we would not be able to give you. Let's see how the pandemic plays out, how the world plays out. So we take it year by year, and that's what we've been maintaining for our guidance. But overall, we can tell you that the demand is looking okay.
And just one question on the margin mix.
Sorry, there is a lot of background clutter. There is a lot of black. We can't hear you.
From your background, could you please check that?
Sorry, yeah. Is it better now, sir?
Yeah.
Yeah. Also on the margin, just wanted to check between OTR and agri. Would OTR have higher margins, and therefore, as OTR grows faster, would that mean a better margin profile on a longer term basis?
Yeah, it would have a slightly higher margin, but overall, we will continue to maintain our EBITDA margin guidance to 28 to 30%.
Okay. Despite the improved product mix, that will likely to.
Because the differential would be little. So we, in this range, there are a lot of other parameters which will go up and down. So we are looking at this guidance.
All right. And one last question on the carbon black. How much volumes did you use for captive purpose, and how much you sold it outside for this quarter, if you could give that number?
So our third-party sales contribution was about 2% of our overall sales in the half year that has happened so far.
Would you be able to spell out volumes in terms of the captive use and?
So roughly it is around 20% of our capacity, which is for the carbon blacks that we sold outside.
Okay. Got it. Sure, sir. Thank you, and all the best, sir.
Thank you.
Thank you. The next question is from the line of Tipen Sangpi from Enam Asset Management. Please go ahead.
Hi, thank you for taking my question, and a very big congratulations to you, Rajiv, and the entire team at BKT for our fabulous results. My question is on the product mix change that you highlighted, which has resulted into a lower capacity, achievable capacity. So as a result of the reduction in the capacity and the change of product mix, what kind of upward movement do you anticipate in the ASP or the average selling price per kilo, what we normally communicate with you, which will kind of make up for the lower capacity?
So I think the ASP should be in that same range. We are not seeing it to go up drastically because there will be a difference of 6 to 7% reduction. But this is we've been seeing this happen for the last few quarters also, which is already coming in, and that's why we are highlighting this fact to you. But that will not have a significant change on the ASP because of that.
Okay, so you anticipate ASP in absence of any, assuming the pricing, no pricing change and everything else remaining equal, with the current product mix, you anticipate ASP to be more or less constant at what you reported in quarter 2, which is 250 to 253 rupees per kg. Will that be a correct assessment for next 18 to 24 months period till the time you get additional capacity?
Yeah, I mean that would be a good assumption. Only thing is so there has been some contribution on terms of forex also. So when you're assuming everything being stable, assume that also to be stable. Otherwise, more or less we can say between 245 and 250, 252 to be a stable range.
Okay, got it. Thank you so much, and looking forward to your details on the Capex. Thank you.
Thank you.
Thank you. The next question is from the line of Niken Shah from Motilal Oswal AMC. Please go ahead.
Hi, thanks for the opportunity. I just have one question. When you said about the guidance for the full year to be marginally up, is this conservatism also coming because of the fact that in the first half, a lot of your competition, whether it is India or outside India, had capacities not running at optimum utilization the way you were running, and hence that benefit might not sustain in the second half, and hence that guidance? Is that a right assumption?
So I think overall market has been good, and I don't know about our competitors, we can't comment on that, but what we are seeing is there is a good demand for BKT products, and people are that is what is contributing to this. But the reason we are saying conservative guidance is because as we are talking, the second wave of COVID is coming back. So there is a lot of uncertainty what happens. They're starting off with a smaller lockdown or lower lockdown than what they did earlier. But we don't know what shape and what form it will take. So, looking at one quarter or looking at this, it's difficult to say that things will change or not change. So hence we are being conservative in our approach because of the current pandemic situation, and none of us can highlight what exactly will happen in the next few months owing to this situation, and hence the conservatism is coming in.
No, I was just trying to understand, would there be a significant amount of benefit that you would have got because the capacities of some of your peers that globally might not be functional, and hence they would have seen supply issues and you would have taken that advantage? I'm just trying to understand that.
I wouldn't be able to comment on what our competitors would produce or not produce, but the demand had been fairly good, so which has resulted in this.
Okay. Thank you, sir, and best of luck.
Thank you.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi, sir.
Hi.
So firstly, on this Euro INR realizations, we mentioned that probably will be around 85 rupees in the second half. If I look at the current rate, it's around 86, 87. And if I book 1 year forward right now, probably you'll get a rate of 89, maybe 90 for next year. So shouldn't FY22 realization of Euro INR should be higher than, say, 86, 87?
Yes, it should be higher. But, these are the levels that we are currently at. As we go ahead and book more, it should be higher.
Okay. So next year should be higher than 85, definitely.
Secondly, currently it looks like that.
Yeah, okay. And lastly, on the mining and tire part, basically, we have now launched 57-inch also. But overall, in this ultra large mining tires, which is 48-inch plus, Can you provide some color on what kind of volumes we are doing currently, or what part of our sales comes from there, and how do you see the traction going ahead in this segment?
So mining, we are quite upbeat. We have always been upbeat on this segment. And, as I mentioned earlier, our ultra large tire was also launched in the last week. So this should be, giving you a good sense that we are quite confident of this segment. And we look to, grow much faster in this segment to gain more market share, because our market share in this segment is particularly low compared to where we stand in the agricultural field, off-highway space.
And which geographies we are currently doing well in this segment? Will it be mostly Australia will be the largest market for us in that segment?
India would be good, Australia would be good, and North America would be good.
Okay. So I think that would be a growth opportunity area for us for over the next 3 to 5 years.
Yeah.
And in this segment, the realization would be higher than what we get on an average in our agri or OTR.
Marginally higher, yes, marginally higher.
Okay, I got it. Thanks a lot. That would be fine.
Thank you.
Thank you. We take the next question from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for taking my question, and congratulations on good set of numbers. I had a couple of questions. Number one is, I know that you cannot give guidance on, you cannot speak much on the quarter 3 as it is under the way, but if you just look at the numbers of quarter 2 this year and maybe first half and compare it with last year. So as we saw that in the last year, there was some dip in volume, particularly in quarter 2. And we had some slippages in quarter 1 of this year. So how much of that percentage would impact the growth in quarter 2 for this year? Can you give some color on that?
On quarter 2, we just finished the quarter 2 numbers.
Hello? Yes, sir.
Sorry, you said what would be the impact on quarter 2?
Yeah, so basically what I meant to say is the numbers have come really good, but as in a large impact was because of this lower volumes last year and slippages in the quarter 1, right?
No, it is overall there has been a demand, so there is no, it's not like because there was a backlog of Q1 which is coming to Q2. It is, demand of Q2 itself. Yes, there may be some. I mean, it will be difficult to say that there was nothing of a backlog, but it is not that the big change has come only because of the backlog.
Okay, so that has not impacted the performance. Okay, great. Glad to know that. The second point was, since our India market is growing really well now, can you give some color on the competitive landscape, maybe in terms of who are our top 2, 3 competitors right now, if you can share?
So I can tell you this, that BKT's market share is about 5 to 6% in the Indian market space. So we have a huge market available to us, and we are focusing on that. And everybody who manufactures tires is our competitor, and we work there. But it's a good market. There's a big market available, so we are competing currently to just see that how we can grow in this market.
Okay. And what would be the impact of margin given our share in India is increasing at a very good speed over the last, say, couple of years now?
What is the impact of the margin? So there is India is slightly sales volume, the selling price and realization is slightly lower, but all this is counted into our current numbers also. So overall, it should not have a very significant change if you look at the cumulative basket.
Okay, sir. I'll come back in the queue if I have other questions. Thank you so much.
Thank you.
Thank you.
Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments.
So we once again thank everybody for their time and to come up and hear us. And also, before I close, I would like to wish everybody happy Diwali on this festive occasion. Please be safe. Please remain cautious, and hope you and your family have a great festival in the coming few weeks. Thank you.
Thank you. On behalf of Equirus Securities Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your line.